Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about Bharat Forge, one of the leading exporters of HCVs and MCVs products, and they are into auto ancillary. Let's understand what you need to do in the stock and how it is placed at the moment. So, let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I am not in favor or against any company that I talk about. Now about the company, Bharat Forge was set up in 1961 and they manufacture forging and auto components for heavy commercial vehicle and medium commercial vehicles. They also have a arm into defense, so they also produce defense products like missile ancillaries or tanks ancillaries. But major business of theirs is exports to North America with the shafts and gears etc. for heavy commercial vehicles, and it is a part of the Kalyani group, which is into steel and other metal products as well, and they have a huge conglomerate business to work with. uh, it is also into power, construction, and marine and railway related products. So it's not that they are only an auto ancillary play, but yes, major portion of their business comes from auto ancillary into heavy commercial vehicles. Now coming to the financials of the company, well, the sales have dropped appreciably year on year. If you look at the second quarter earnings, which has come up recently, I mean the sales have dropped at 25%, whereas the operating profit has dropped 26% to 320 crores from about 434 crores. So it has dropped 26%. Right now it is trading at a PE of 20, which I feel is slightly expensive at these levels. The return on equity is close to 20%, just under it, whereas the operating profit margin currently stands at 15%. One needs to understand that this is a really good company for buying for 8 to 12 years period, because they have a defense arm as well, in which it could be a defense play. And when you get good orders from the government in the field of defense, then the order book as well, as you can say, the profit and loss account goes up pretty well. But if you don't get orders for a longer period of time, then you have to rely on auto ancillary business. This company right now majorly into auto ancillary, but the defense thing really goes well, and that's why probably the PE is slightly higher. So the performance of the company and the stock, as I mentioned, the stock is down 45% from its peak of 2018. So the stock is trading at, I think, around 400 something, whereas the high was around 800 odd. So the stock is already down some 45% from its peak. The growth is slowing down over the course of last 2 years because of what is taking place in North America. The valuations, I believe, is still expensive at 20 times, because there are many companies into auto ancillary which are into four wheelers and two wheelers that are coming at a P close to 10 or below that. So I believe that there could be more correction coming in the next 1 year. The management is pretty strong. The Kalyani Group management you could rely on, as with other top management in the markets that you see. So it's not that there would be any management issue, I don't think so. And there is a good dividend payout ratio over the years, and they pay quite a good dividend. Right now the dividend yield is around 1.4%. That's why I believe that there could be a little bit of fall remaining, so the dividend yield goes close to 2%, and that would be an opportune time to buy. What were the reasons for the crash in the stocks? As I mentioned, heavy commercial vehicles is under pressure in North America. In fact, the normal retail sales of cars has gone down in America and across the world. And we have seen what has taken place in Europe as well. They have business coming in from UK and Europe as well, apart from North America, but their major business is from US and Canada, with those heavy commercial vehicles that mow down places like Alaska, etc. So, what has taken place is that the demand has really gone down over the last 18-19 months, and probably there will be demand pickup. We have seen green shoots come up with the Mother Sansumi numbers that Europe is coming back from the brink. So there we could see the same situation with the US and North America in the next 2 to 3 quarters. But over the next 1 year, there could be pressures on the bottom line and the top line because of the demand slowdown. Up and add to that, the domestic auto numbers have also plummeted. So the domestic auto sales, as we have seen, even in four wheelers and normal retail vehicles, has gone down. So when we talk of commercial vehicles, it is right now close to zero. And because of lower infrastructure spending and whatever has taken place with this with real estate and infrastructure, there are lesser demands for trucks. And here is where the trouble lies for Bharat Forge, but we could see a recovery in the next 1.5 years or so. So one has to take that into account, that when the recovery comes, the stock might already have a run up. So if you want to invest, these are pretty good levels to invest in. Apart from that, higher raw material cost, machinery cost is also taken a toll, because the expanded capacity is working continuously day in day out, but the amount of production that it needs to do is less. So the company is not working at full capacities. That is the concern with all the auto companies, and we have seen Ashok Leyland shut down many branches because of this for a few days, as the demand has slowed down so much that there's no point producing products day in day out when there is no demand. Also in the markets itself, there has been a mid cap slam down. So the mid caps have been absolutely butchered out of shape over the last 2 years, since January 2018. And so one needs to have an understanding that yes, there has been a lot of selling, and we could see a comeback of mid and small cap, I believe, in 2020, somewhere in 2020 second half or in the middle of 2020. So the sector is out of favor, the mid cap has been slammed down, and the company is also not doing well because the sector on the ground is under a lot of stress. So what needs to be done? I believe that you can accumulate the stock at these levels, and on any 10-15% declines from here because of sharp slam down in the markets, because when the big indices go down, when Nifty and Sensex will go down, these stocks will also fall, because mid and small cap might not fall that much, but they will fall. So you'll get opportunities. So wait for turnaround in the sector in the next couple of years. Have a 5 to 7 year view, and do not invest more than 5% of your portfolio, as I mentioned. So this may test your patience, but this will give you great reward, because I've seen the stock run up very well in between 2014 to 17, and we could see the same thing happening after 6 to 8 months. So probably in the next 1 year, invest over the next 1 year to 18 months on a periodic basis, on a monthly or a quarterly basis, and invest when the stock falls a lot. So this was my video on Bharat Forge. Please like and subscribe my channel, hit the bell icon so that you can get my video straight away when I post it. Thanks a lot for watching.